Guys, we are meeting here in second lesson in inventory. So in inventory measurement, it says cost. It should be measured lower of cost or net present value, net realizable value, whichever is lower, right? The inventory um, International Accounting Standards number 2 says measurement of inventory should be lower of cost or net realizable value, whichever is lower. You have to take it, right? Here in the cost, how to determine the cost in the sense the cost incurred in bringing inventory to its present location and condition. All the expenses incurred in bringing the asset to the present location and condition associated with the all cost with them with that process is has to be accounted as cost. Okay, so earlier session we have seen in deeply. This is to refresh your mind. Okay, here net realizable value says selling price less cost of conversion, right? Selling price minus cost of conversion and cost of distribution, that is net realizable value. Okay, net realizable value is selling cost less cost of conversion and cost of distribution. That should be the, this has to be reduced, this has to be reduced. Okay, okay, that should be the net realizable value. So shall we directly go to the question, right? Exercise, right? Here in exercise, Bravo manufactures components for the retail industry, right? Bravo manufactures components to the retail sector in the market, right? And he used to supply to the retail sector, right? So the investment is currently the inventory currently valued at cost. The inventory is currently valued at cost. The cost structure is given below. The cost structure is given below, right? They says here is a cost per unit and selling price per unit. In cost per unit, they says production process first stage. This is first stage, right? First stage, cost is 1000 and selling price is 1050. Conversion cost, that is a second stage, cost incurred is 500 and finished goods 1500 and selling price is 1700, right? Okay, having said that, the examiner says the selling cost here, the selling costs are 10 rupees per unit incurred by the Bravo and has the 100,000 units. Okay, 100,000 units, 100,000 units at the first stage of production and 200,000 unit of finished products he has in hand, right? 100,000 at the first stage and 200,000 at the end of the production, not end of the production, finished goods he has, right? Shortly after the year end, a competitor released a new model and this has resulted in Bravo having to reduce its selling price to 1450. What happens? He has revised his selling price. Okay, revised his selling price. Okay, this is the cost of 10 rupees for the finished product, right? For the finished product, and 950 for the first stage production. Calculate the inventory value of the inventory. What happens, the when he was doing the production, while he was doing the production and marketing his product, one of his competitor all of a sudden introduced the new model, which is new model of similar product in new model he is introducing to the market. So if you introduce a new model in the market, most of the customers are drawn towards the new model, right? Most of the people go and buy for the new model, tend to buy, right? So in that case, the demand for Bravo's product will come down, then he has to suffer a heavy losses. So what he said, what he decided is, he smartly thought that if he brought down his cost, selling price, there may be a chance to sell his product, there may be a chance to move his product and fight with the competitors new model. That's what happened here. So all of a sudden he reduced his price from 1700 to 1450, right? Finish. So that has happened, and he has, so we have to calculate the net realizable value and cost and real cost of it, right? This is the unit cost, 100,000, 200,000 of finished goods, right? Finished products, right? So again we will go through. Bravo manufactures components for the retail industry. The inventory is currently valued at cost. The cost structure is given below. Production this much, he has given. So first of all, we have to say, one is production process first stage, right? Production stage 1, stage first stage, first first stage, right? First stage, right? Production process first stage and finished product, finished product. For this only we have to calculate the cost, because these two only they have given the this thing, right? Here we have to say, we have to see cost per unit they have given, right? Now we don't need to get the cost per unit, right? We will see the selling price. We will take the selling price, net realized. We want to calculate the net realized price, net realizable value at the beginning. So for that, what we knew what we want is selling price, selling price, right? You will say selling price, right? Selling price, right? right? This is selling price. From the selling price, what are the costs you have to deduct? Conversion cost and selling and distribution. Conversion cost, conversion cost, right? And what they have said, they have said selling cost, right? Selling cost, selling cost, right? Selling cost. So selling price has to be deducted from selling price. You have to deduct the selling cost and conversion cost. That then you will arrive at net realizable value. Net realizable value. This is the net realizable value. Okay, this is net realizable value, right? Okay, understood. So next one is the cost. Here we will say cost per unit. This is net realization value per unit. Okay, cost per unit. Okay, cost per unit. Here we have made in such a way where you can do it very easily and very quickly to attempt the question and finish it off, right? So we have got net realizable value, cost per unit, right? Thereafter we can compute the which one is the lower and which one is higher, right? So from that we can get it, right? With this process we can stop, otherwise we can move furthermore. That means cost per unit and units, number of units in hand, right? Closing units, closing stock, closing units in hand, units in hand, right? Units in hand into cost price equal to value of total units, value of value of inventory, value of inventory, right? So here I want to make a drawings. If you want you can make it as a chart, right? Make it as a chart. Here you can say total, right? Total. Then now we can come for the question, right? We have taken all the required, this thing we have taken here. So now we can take the price. What is the selling price? This is 1450. 1450. Here also we have to take 1450 as a selling price. This is immaterial, just you ignore this 950 because we are going to calculate it from the net realizable value at the end of the product, right? End of the product is final product. From that only we are going to do the calculations, right? So this is what we are taking, selling price. What is the conversion price? For production stage 1, no conversion cost. Then production finished product, we have a conversion cost of 500. Okay, here selling price, selling cost 10, 10. It is incurred, we have incurred, right? Net present value, what is the net present value? Okay, here here you have to say 500 conversion cost, 500, right? Here you don't have to deduct anything, right? Conversion cost 500, because we are arriving at the cost at the stage 1, right? This is stage 1, this is a finished product, right? Stage 1, we have to deduct the conversion cost from the production price, selling price. Selling price, from selling price we have to deduct the conversion cost now to arrive at the net realizable value at the production side, right? So here we have deducted this way, and we are getting a net present value of, net realizable value of per unit is 960, right? 960. Here we get 1440, 1440, right? 1440. What is the cost per unit? Cost per unit at the beginning 1000, right? 40, 1040, right? 1000. Here 1500, right? What is the cost per unit? They have given in the question stage 1000 and finished product 1500. So what is the net present value? Net present value should come this side, right? Okay, this is the 960, 940, and this is the 1000. The difference has to be taken, right? Difference, the inventory should be valued at net present value, net realizable value, net realizable value, because when you compare with the cost of cost per unit, the net present value is lower, whereas we have accounted for in cost per unit earlier. So net present value, then we would have overstated by 60. Here also 60. 60 rupees overstated. So we have to make a adjustment, right? So value of the stock will be 940 into number of units. What is the number of units? Number of units available is 100,000 at the first stage, and stage 2 200,000, right? So here I say difference, difference, or cost price, we can say cost price. If we say the price we have to apply, then we have to apply the net present value, okay, and value of the stock, value the inventory, right? So here we say we have to calculate cost is NR, cost is net realizable value, right? So here we have to 60, 940, right? Here we have to say 1440, right? Right? But here we would have calculated year end, right? The Bravo manufactured the retail industry and the inventory is currently valued at cost. The cost structure is given below, right? This is the first. Shortly after the year end, no, the selling cost 10 and per unit, and Bravo has 100,000 units at the first stage, and production stage 200 units of product closing product. This is, we have to think in such a way that it is accounted for 1000 units, right? We can assume that they didn't ask, they are just asking the cost, calculate the what you call the inventory cost. If that is the case, we have to calculate like this, right? We have to calculate like this, right? So this one, 1 2 3, right? 1 2 3, right? 90, this is 94 million. It comes to 94 million. Okay, here it says 1 2 3 and 1 2 3 8 8 and 2, 288 million, right? 288 million. If you add this sum to 382 million, the inventory cost, actual cost, whereas they would have made 100 into 100, right? 200 into 1500, right? Right? That is the what, that is how they would have made. If that is a case, 3 million and 1 million, 4 million would have come, right? Here if they have taken this amount, right, then they would have arrived at this amount. 382 million should have gone to the inventory account, right? Inventory account, this is the inventory value, inventory value. This is the inventory value should be shown in the accounts, whereas they would have shown 400 million. 100 into 100, 100,000 into 1,000, 200,000 into 1,500. In such a way they would have computed. If they have taken 100 and 1,000 and 1,500, here we would have got 100 million and here 300 million, then here we would have 400 million, right? So difference. If they have asked the year end, they have made the adjustment for cost. Now they wanted us to revise it, in the sense the difference only we have to take. The difference only we have to take. Just have you understood this one? Have you understood? We have taken the net present value. That you have, you got it into your mind? This net present value, right? This net present value only we have applied here. Cost, net present value, right? That's what we got this amount, right? Because we have compared the net present value with the cost of the product, right? Where when we comparing, the cost of a product is more than the net present value we have arrived at, calculated and arrived. That amount is lower than the cost price. That's what we have taken lower amount for the valuation of inventories here. Here also like that. Here 1450 it is a lower price. Here is 1500 higher price. So 1440, right, into 1400. Then we have arrived this. This is the value of the inventory we have to take. Then total this into this. Okay, understood? If they ask you to calculate the difference, right, what is the they have accounted as per cost price. Now if the company has operator had been the accounts had been recorded at cost, in the sense, what you have to do, you have to, if it is a net present value, you take net present value, right, right, net present value of the product 1, net present value per unit, right, this is cost per unit. Okay, net present value 940, this one is 1440. This is answer for a, right, this is answer for b section, right, 940, whereas the cost is 1000, sorry, cost is 1000, here 1500. Then what is the it is the difference is 60, right, minus 60 minus, right, 60 minus 60, that should be, you had to multiply units is 100,000, this is 200,000, right, this should be how much, 1 2 3 3 6 million, and this one is 12 million, 6 and 12 million, total 18 million, 6 and 12 18 million. We have to adjust it, 18 million right now. If we adjust 18 million, we will arrive at 400 million. So how, what we have to do is 18 million we have to reduce it from the inventory value, if we have accounted as per cost, right, if that is the case, if we accounted for cost, okay, we have to, space is not enough, right, we have to 6 million 6 mil 6 million 6, sorry, 6 million we have to account for product first stage, right, account for profit and loss account debit and inventory credit, right, profit and loss account debit, inventory account credit. For this also, this is 12 million for finished goods, finished goods 12 million we had to, P&L, profit and loss debit, and inventory credit. That's 12 million. This is the double entry. We have to go for the, if we say they have recorded, if they have recorded at cost, if company recorded, that's what they said, it is recorded at cost, right? In the inventory retail industry, the inventory is currently and valued at cost. Valued at cost. Valued at cost means they would have valued at this amount. Okay, valued at this amount. So this is the incremental value which had to be reversed. They have accounted for 1000 per unit, right? 1000 per unit, right? Here itself we can correct it, right? Here also, right? Here they have said currently the valued at cost. They have valued at cost. Then we have to see the difference. Very carefully read the question. Valued at cost. This is the important matter in the question, right? So the incremental cost is 60, 60, 60, right? Then value 60 into 100,000, 6 million, right? Here is 12 million. Here is 18 million. Inventory adjustment. Adjustment. Right? This has to be debited to P&L, debited to profit and loss account. This is credited to inventory, right? This one will debited to P&L, P&L. This is credited to inventory. Okay, understood? This is the adjustment we need. 12 million has to be P&L and credited to the 6 million, 6 million, 12 million and 12 million, right? In this way also we can present it. In some other way also we can present it, right? What we can do is product, we can say production process first stage, production process stage 1, first stage, first stage, first stage, right? In that what we are going to take is selling price, right? We are adding selling price. Selling price, how much? Selling price, how much? 1000 in stage 1, 1450. What is the conversion cost? Conversion cost, how much? 500, right? And selling cost, how much? 10. This has to be deducted, this has to be deducted. Then we will arrive at 940, right? 940 at net realizable value. Then we will say cost per unit, how much? 100. Cost per unit, how much? 1000, right? The difference, then difference, difference is 60, right? 60, the difference is 60, that is this. Then we are saying number of units, number of units in hand, in hand, 100,000, right? 100,000. Then what is the adjustment need? 100,000 amount to be adjusted. 100,000, 6 million amount to be adjusted. Amount to be adjusted. That is P&L, profit and loss, debit, profit and loss, and credit, debit, profit and loss, then credit, what account? Inventory, inventory, right? Debit, debit, P&L, P&L. So you can work it out. Then finished goods, selling price, right? Say selling price is 1450, and what is the selling conversion cost? Not there. Selling distribution, selling cost, selling cost 10, then 1440 is the net realizable value. The number of units in hand, number of units in hand, that is 200 units 200,000 units. Then, sorry, very sorry, we had to go for the cost, right? Cost per unit, cost per unit is 1500. Then decrease in value difference is this. A number of units in hand, that is 200,000. So adjustment need 12 million, right? Amount to be adjusted, be adjusted, right? Amount to be adjusted, that is debit and debit and credit, right? This is debit to PNL, and this is credit to inventories, right? Why it has to be credited? I will draw the T accounts and show you. Here for the production cost of number stage 1, this is for inventory, right? This is for inventory account, right? This is inventory. First stage, first stage, inventory. This is credit and this is debit, right? This is finished goods. This is finished goods. This is debit, finished goods, credit, right? Here they have said they are currently valuing at cost, valuing at cost in the sense 100,000 units into 1000 rupees, right? So brought forward, always inventories will have a debit balance brought forward, right? Brought forward balance is 100,000 into 1000. 1 2 3, 1 2 3, right? 2 3, and you know, this is 100 million, 100 million, okay, 100 million. Here it has 1500 into 200 units, 1500 cost per unit into 200 units. Then here finished products brought forward balance should be 1 2 3, right? 1 2 3, right? And This is 300 million. 300 million brought forward balance. Now we have to bring it down to the cost. Cost means 940 into 100,000. 940 into 100,000. So difference is 60. We had to pass the entries for the difference. Here is the difference 6 million. Right? We had to credit the 6 million. 1, 2, 3. 1, 2, 3. Right? 6 million. This is for P and L, profit and loss. It will go to the profit and loss. Profit and loss account. Profit and loss account. Profit and loss account will be debited 6 million. Saying inventory. Inventory first stage 6 million. Here they say 12 million. Right? We have to credit to the 12 million P&L, profit and loss account. Right? What is the carrying down value? Carrying down is 298 million, 288 million, right? Brought forward will be 288 million, right? Here we will have carried down value of 94 million, right? 100, 100. Brought forward is 94 million, 94 million. Okay, 94 million and 288 million. This is the carrying down value. Okay, if you compute 940 into 100, 94,000. 1140 into 200, 288,000. Right? It should vary the way. Okay, understood? Okay, so I am going to answer. You would have understood this part of question. We have seen the correct part of the answer of this one. 18 million, 12 million, 12 million plus 6 million is 18 million. I have shown both sides of two way of presentation. This is the number one presentation. This is number two way presentation number two. Presentation number two. Presentation number two. Presentation number one. Right? I showed you two ways of presentation. This way also you can calculate. This way also, vertical and horizontal method, you can handle which one is easier for you, right? This way also you can calculate, this way also you can calculate. So this is the PNL. I have not PNL in the inventory account. Inventory account we have showed you to for your better understanding purposes. I have shown the inventories also here. Account that is not needed. They ask the how much the differences. What is the difference you have to make entry for the because they are calculating at the current valued at cost, at cost. That is what the thing. Otherwise you had to calculate the whole amount. Otherwise, what you have to do is, if they have not mentioned this valued at cost, in the sense you don't need to go for the what he called difference in net realizable value difference. Right? This is difference, right? Cost, not cost, difference, right? Difference, right? Difference in our value. Hence, difference is 60. So you have, otherwise you had to have you had to multiply the 940 into 1000 unit, 100 unit, 100,000 units, 1440 into 200 units. Then you will arrive the value of the, directly you will arrive the value of the inventory, 940 into 100,000. If they don't mention this current, it is not, it is mentioned at the cost. Okay, so this is the way of percentage. Understood? So shall we move to the other part of the question? I am going to raise it. Take it down. Please take it down. Okay, shall we move to the next question? No, next exercise. Next exercise says requirement is prepare the P profit and loss account, right? So prepare P and L, right? Prepare the P and L, profit or loss, trading and profit and loss account, right? That has to be prepared. We will open a trading and profit and loss account, right? Trading, right? Profit and loss account. Okay, this is, we say, trading account. Okay, this is debit side, this is trading, not writing. Okay, right, say this is trading account, debit, and this side is credit. Okay, trading account, right? Here they say year one, right? We used to say here year one. In the year one, they says business had purchased of 20,000, right? Purchases, no opening stocks, no there, not there, not there. Then purchases how much of the 20,000, right? And they said sales was 30,000. Sales was 30,000, right? 20,000 less, then 20,000 less closing stock nil, and you are arriving at 20,000 cost of sales. Cost of sales is 20,000. Then you are balancing this one to 30,000, right? Here you are balancing to 30,000. Then 10,000 is difference come to gross profit, right? In the year one, they says the sales made to 30,000. Sales is credited. If the sales is credited, sales will have a credit balance that will have Transfer to trading account 30,000. Purchases 20,000. Purchases we have made 20,000. There is no opening stock, there is no closing stock. Then this is called at cost of sales. Cost of sales, right? Sales, cost of sales. To make 30,000 sales, we have incurred 20,000 rupees, right? To make 30,000 sales, we have incurred 20,000 as a cost. That's what we say cost of sales. So the difference in between the 30 and 20 is known as gross profit, right? Not a profit. This is called as gross profit, right? So this is the gross profit 10,000, right? In the year 2, purchases they say 32,000, 35,000. In the year 2, opening stock not available, purchases they say 35,000, right? 35,000. Then next information given is sales 50,000, SAL sales 50,000, right? And next is we have to deduct the closing stock, right? This is known as closing stock. Have they given the closing stock? In they says inventory at the end of the year was 5,000, right? 5,000 is the closing stocks. Then cost of sales is 30,000. Cost of sales is 30,000. So here you will bring down this 50,000 as this is the greater amount. So here you will put that 50,000 as it is the greater amount. So the difference is 20,000. Difference is 20,000. This is known as gross profit. Gross profit. Right? Understood? This is known as gross profit. Sales 50,000 made credited. Trading account is credited with the sales 50,000. The purchases 35,000 debited, right? Then closing stock deducted from the 5,000. Then cost of sales 30,000. Then gross profit is 20,000. Okay. In the year 3, yeah, opening stock was is the this is the opening. Closing stock becomes the opening stock of the subsequent year, right? Closing stock becomes the opening stock of the subsequent year. Then purchases made 38,000. 38,000. Then 43,000 minus closing stock. STO stock closing stock. What is how much the closing stock? They said 6,000. This has to be done, right? Then 37,000 is the cost of sales. What is the sales? Sales during the year is 30,000. 60,000. we had to balance 60,000 as it is the greatest amount. 60,000 and 23,000 is the gross profit. It's the gross profit. Understood? This is the gross profit. At the year 3, you wonder what happens. In the inventory account, I will show you. Inventory account. Right? Opening stock, they had an opening stock of year 3 only. I will show you. Opening stock here. Opening stock, you say opening no, we'll say the year 1. From year 1 we'll say, right? Year 1 closing stock, there is no opening stock. Opening stock not there, right? This is stock. They said year 2, right? In the year 2 they said stock is 5,000, right? 5,000. This is the carried down value of 5,000. Then the brought forward value in year 3 is, brought forward value will be 5,000, right? They says year end carried down value is 6,000, right? Carried down value is the 6,000. So it should be brought forward value for the next year, right? This will go to the balance sheet. This amount will go to the balance sheet. Okay. Okay. This will go to the P&L. Profit and loss account, they say 5,000, right? Here balance sheet, it will go to the 6,000. So 11,000, 11,000. Right? This will go to the profit and loss account 5,000. Here we have added profit and loss account and closing balance sheet. It will go to the balance sheet as a 6,000 carried down balance sheet. Right? This is the what? How much? Have you understood this section? Right? Here you have to see the difference, because here if it is 5,000 closing stocks, the closing stocks of the previous year will will become as an opening stock of the subsequent year. That is year 3. This is year 3. In the subsequent year, this closing stock of 6,000 will go to the year 4 as a opening stock. That you have to understand. There won't be any difference between this. This is the uh, rule, right? Or previous year closing stock should come as a opening stock of this current year, right? That's it. That should carry down. That is what we are bringing this 5,000. Right? So this is what we have to say. Purchases debited, opening stock 5,000. Add purchases, right? Add purchases less closing stocks. Then you will arrive at the cost of sales. Cost of sales. Right? Sales 37,000. Then you will arrive at the gross profit. Understood? Okay. Okay, today I am concluding this session, and I hope to meet you in next lesson. Okay, thank you for watching. Please subscribe, and if you have any doubt, please don't hesitate to contact me. Okay, thank you.